Hi, I'm James Robinson, and this is my stock pick of the week. My goal when I created this blog is to create a community of people who are interested in value investing, a place where we can openly trade ideas and give each other advice. I don't claim to have all the answers, though I feel like I've done my share of homework. So if you like the blog or find it interesting, please drop me a note in comments. Of course, subscribing and liking are also great as they help me get exposure and build a community. Thank you for watching. My pick of the week is simply a stock that I think represents a great buy that week. My criteria for what makes a great stock is very simple. I look for great companies with a durable competitive advantage and or extremely good returns on invested capital. Only after I find companies that qualify under that criteria do I look at the stock price to see if they're fairly priced. My definition of a great company and a durable competitive advantage come directly from my study of Warren Buffett and the various investors in his orbit, people he would call the super investors of Graham and Doddville. It starts with the book Security Analysis written by Ben Graham and David Dodd. What I do not do is look for the next great thing. I love Tesla, but not its stock. I'm sure there's a solar company or self-driving car company or super duper gadget company where a $10,000 investment today could make me a billionaire in 6 months. But I don't know how to find those, so I don't look. I simply look over and over again at company after company, looking for companies that are great. Then I watch those companies for when the stock prices become attractive. That's all I do. Thank you for watching. Today's stock pick of the week is Disney, D-I-S. Disney is a global media company. It operates cable channels under its ESPN, Disney, and Global brands. It has broadcast business through its ABC television brand, as well as owning 8 television and radio stations. It produces movies under the brands of Pixar, which makes Toy Story, Lucasfilms, of course famous for Star Wars, Marvel with the Avengers and Spider-Man, and Touchstone, Armageddon and Pretty Woman. The company also owns and operates and manages theme parks in California, Florida, Tokyo, Shanghai, and Paris. They operate a cruise line operating in California, Alaska, the Caribbean, and Europe. The 4 ships can carry a total of 13,000 passengers per week. As if all of that weren't enough, the company has a huge library of films, predominantly child-based, which it releases periodically. They also have valuable licensing rights to their characters, which include Mickey Mouse, Donald Duck, Darth Vader, Spider-Man, and Buzz Lightyear. The company has 201,000 full-time employees, and it's based in Burbank, California. Disney has a market cap of $256 billion. Its revenues are 59.7, call it $60 billion. It has profits of 13.56 billion. Its PE ratio is 15.94. The yield is 1.23, and its debt is $17 billion. As we talk about every week, I grade companies in 29 categories. I grade a company 1 through 4, 4 being the highest, 1 being failing. The 29 categories are comprised of 9 components of operating. Operating is how well you deliver goods and services to your customers. There's 10 categories of financial, which is how well you do with debt and risk. And there's 10 categories having to do with management, and management is comprised of how good a job you do of returning wealth to the shareholders. Disney, I've analyzed almost 1,000 companies. Disney is in the top 30 of all the companies I've analyzed, with a total GPA of 3.48. This is an example of getting a fantastic company at a fair price. So in terms of individual stats, I always look at gross margins first. My logic here is simple. Gross margins give you the opportunity to make mistakes. If your company has really high gross margins, then some things can go wrong and you can still be profitable. But if your company has very, very narrow gross margins, then almost anything that goes wrong can cost you all your profits. My minimum gross margins is about 20%. I like to see 40% gross margins. And you can see that between 2011 and 2012, Disney changed from a company with relatively narrow gross margins to a company with exceptional gross margins. A lot of things were happening that caused that to happen. They bought Lucasfilms, which threw a lot of money into the business, both through the films and through licensing. Also, Bob Iger had been in the business long enough that he'd gotten rid of some Miramax and some others, a country music label they had, and some other things that maybe weren't as profitable as they could have been and were dragging down those margins. But basically during the Iger era, which started in about 2009 or 2010, this company's been fantastic and has been just a wealth creator for us shareholders. You know, they say famous people need no introduction, and it's fair to say that when you look at a chart like this for earnings and earnings per share, you know, you don't need to say much. I mean, in 2001, the company was barely profitable. It had $3.5 billion in earnings in 2009, and today it has 14,000. It's a four-time fold in 10 years. Bob Iger has made owners of Disney very, very wealthy, and is well paid, but should be more well paid. So this stock is fantastic when you look at this chart of growth. And earnings per share is even better. And again, that's because they've been buying back shares, but more about that later. So net earnings as a percentage of revenue, you can see that this company has been really increasing this number since about 2001. It got into the top 25% of companies that I look at in about 2010, again, when the Bob Iger era started, and is now sort of above my goal, which is one of the reasons why I think it's a good company to buy today. But again, we just like this, that it's getting better and better every year. This isn't, by the way, not earnings going up. This is earnings as a percentage of revenue. So this is an efficiency in taking gross dollars into the door and turning them into profits. They're getting more and more efficient and better at doing that. So this is the kind of trend that we love as an investor. So selling and general administrative and plants and equipment, we talk about this every time. There's 4 taxes that a company has after the cost of goods sold that are a good indication of how well the company is run. Selling and general administrative is the first of those. Plants and equipment is the second. Research and development is also one, as well as inventories. So let's start with selling and general administrative. You can see that, again, when Bob Iger era started, this company was in between the top 25 and bottom 25, so sort of marginally acceptable. That number has increased basically every year since then, and now it is in the top 25%, so it would get a rating of 3 out of 4. But again, that number continues to improve. The next issue, which is plants and equipment, you're going to see is kind of right in the very middle, right there, about 20, sort of in between the top 25 and the bottom 25%. But that makes sense. This is a company that owns theme parks, and they generate about $25 billion a year. About a third of the revenue comes from, about half of the revenue comes from theme parks, and about a quarter of their profits come from theme parks. So when you're running that big a business as a result of these theme parks, of course you're going to have really high real estate costs. Also, the thing you have to think about is that the theme parks, they create a synergistic effect. People are going to the theme parks and they're falling in love with the characters, and they're buying Mickey Mouse hats and Mickey Mouse gloves and Mickey Mouse lunchboxes. The Star Wars experience that Disney is taking over as is our Avengers and Marvel. So these things are sort of feed on each other. So we're going to have higher plants and equipment than in most companies here, and it doesn't bother me at all. Inventory as a percentage of revenue is really sort of non-existent, not worth talking about. R&D is also non-existent, not worth talking about. So we've got selling general administrative costs that are a little bit high, but getting better and better. We have plants and equipment that are completely in line with their business model. We have virtually no inventory, and we have virtually no R&D. So these are fantastic traits, which further explain why this is such a solid company. So interest expense as a percentage of operating income. I've put these two together because the interest expense of this company doesn't look great. Since 2015, the interest expense has been going up every year. They're not paying down debt. They're actually borrowing more money, although in 2017 they did pay down some debt. But if you look at interest expense as a percentage of operating income, which puts the amount of money we have in context, you can see that the number is, exceptionally good. The goal is to be below 15%. They're never really higher than 11%. And, even though it's gone up the last couple of years, it's still so far below being significant to this company that while the interest is high, and while I don't like companies typically with $17 billion in debt, in this case, the interest is really insignificant relative to the operations of the company. The other thing that I want to point out, I don't always bring this slide up, but this is net interest expense. So we have interest expense that, started to peak in 2017 when they started to borrow, 2007 when they started to borrow money. And you look at it, it's gone up the last few years. However, the company also has some money that's invested that's earning us money, and so we have some interest income to offset some of that interest expense. The green line is net interest income, and obviously it's still not going exactly the way we'd like, but it's better than it would be if we didn't have some net interest income. So I do like to look at pure debt and see what's happening with the pure debt so that I can get a sense of how the company is doing and what's going on with the company's ability to operate without debt and to fund their activities through their own profits. So first of all, current liabilities, you see them going up and they're going up, but they're going up at a rate much slower than the rate the profits are going up and the rate that revenues are going up. So we don't care about, we're totally fine with the total current liabilities. Total current long-term debt, that number has really been going up during the Bob Iger era every year. Although you see again in 2017, they did pay off a little bit of debt. But effectively, you've watched this debt income level raise from about, let's call it 10 billion in 2003 to about 17 or 18 billion now. That's a doubling, although profits have done far more than double. I just like to keep an eye on this. I'd like to see this company paying down debt. I realize they're paying dividends. I realize they're buying back shares. But I'd like to see them pay off debt. It's one of the few things about this company that I don't love. Having said that, years income to pay off long-term debt, I like to look at long-term debt in context, right? If you just look at $17 billion, that's scary. But when you realize it's a $250 billion company and they make $13 billion a year, those numbers become less significant. So I have a goal that a company can pay off its long-term debt in less than 4 years. This is a company that can achieve that goal. And as a result of that, I all of a sudden have no concerns about about the debt relative to its earnings. The next thing that I look at, because debt requires you to pay interest, and because you have to pay interest in good times and in bad, I like to know that the company's interest coverage ratio is many times what we need to have to be safe. So, you'd like to have an interest coverage ratio much better than 2 to 1. You can see this company is as high as 25 to 1. It's been as high as 50 to 1. So this company has all the profits in the world to pay its interest. I can't imagine a scenario where this company, due to its business model, because it's making movies for kids, because they've got the theme parks, which you're going to go to good times or bad, you're going to buy your kid a Spider-Man lunchbox, good time or bad. I think it's reasonable to assume this company's interest is, as a relation to its interest coverage ratio, is just irrelevant. Cash and marketable securities, this number is, going up and up and up, not going up extravagantly. Obviously the last year it has gone up, but I think they just haven't made their, they buy back stock every year, and I think they haven't bought back much stock, and they might have not paid some dividends, which is why it looks like there's a lot more cash on hand at the end of the year than is typical. But I think that you're going to find this number would even out over time. I don't think much happened. I can't see what really happened that made them go from $4 billion in cash and cash equivalents to $10 billion in 1 year. I'm going to assume that's an aberration. But again, the company is strong. They're averaging, they're adding a little more cash every year. Current assets to liabilities, this is a surprising one. The current assets, so that's the money that you have either in your pocket or that you will have in your pocket by the end of the year. Current liabilities are expenses you're going to have by the end of the year. You can see that in 2015, for some reason, the current liabilities for the first time surpassed their current liabilities, and surpassed their current assets. I don't like that. That bothers me. If it wasn't for a bunch of other really strong signs, I would be more worried about it. I'm going to keep an eye on this trait, but it looks like it's getting back under control in 2018. I'm going to assume in 19 and 20 it'll get better and better. I think this is a long-term hold, but if I saw this number getting really out of whack, it would start to cause concern and maybe make it more of a short-term hold. So I haven't talked much about this. We're going to talk about retained earnings. So let me put this in context. A company, when it makes profits, has a limited number of things it can do with its profits, right? It can pay dividends to its shareholders. It can pay down debt. It can buy back stock. And it can retain those dividends for future uses, right? So one of the things that you like to know is if a company is retaining its earnings, what's happening as a result of that? So the first thing that I'm looking at here is just retained earnings. And what you can see that's really special about this company is that the retained earnings, even though the profits are going up, the amount the company is retaining is getting smaller and smaller. That means it's able to get better and better returns on investment, even though it's using less and less of our cash as shareholders to do that. And what that means is that in time, the company will have a significant stockpile of money that it can really pay us back. And you can see that ever since, again, 2008 or 9, this company has had a better than 10% return on retained earnings. What I do here is I look at how much earnings the company's retained over 10 years and what the profits have done over that period of time. And I assume that, and I know it's an oversimplification, but it's sort of the assumption is that the profits that were generated were the result of intelligent use of retained earnings. And I know it's an oversimplification, but it does sort of bear some fruit in terms of analysis. And what you can see here is that this company has been getting close to 25% return on retained earnings up to and about 2015, but for the last couple of years, it's skyrocketed. And it hasn't skyrocketed because the company's made a whole bunch more money. It's skyrocketed because the company has done it with less and less retained earnings. And so if it continues to grow its earnings at some significant pace, and it's doing it without retaining any earnings, you're going to see this number really skyrocket. So what this means is the company's really efficient and intelligent at the way that it uses the money that it doesn't want to give back to us. This is a fantastic sign as an owner. We love companies that do this. So again, we talked about this. Another thing that the management can do with its profits is repurchase shares. And you can see that this company had about 2.2 billion. You got to remember this is, we reduced this by 1 million. So it's really 2.2 billion shares outstanding in 2003. And since then, they've really cut the number of shares virtually every single year. And in 2009, they have under let's call it 1.4 billion shares outstanding. That means that every year we own a larger percentage of the company. And you can see the other half of that slide is that they're just steadily buying back about between 80 and 100 million shares a year. So let's put that in context. If you own 10% of Disney stock in 2008, you'd have owned about 189 million shares. Today, through stock repurchases, your 189 million shares would mean that your ownership in the company has grown from 10% to 12.6%. So you've had about a 30%, 25% increase in the amount of the business that you own. And to further put that in context, your share of the company's earnings over that 10 years would have been gone from 361 million to 1.67 billion. So you own a larger portion of the company, and the company's making a lot more money. And so, and I realize all of these earnings don't directly come back to us as owners, but when you look at the company, they have, again, 4 things they can do with those profits. They can buy back dividends, that's money to us, the owner. They can pay down debt, which by the way, they're not doing, but they could, which increases the value of our assets. They could buy back shares, which means we own a larger and larger percentage of the company, or they could retain the money and use it to invest in the business. And the money they're currently retaining, they're getting better than a 25% return on. So this is a fantastic, when you start thinking about this and you understand what's going on with the money and the profits this company is generating and how intelligently and efficiently they're being used, it really is a cause for excitement as a shareholder. Dividends per share, you can see that they just keep going up. I think there was a special dividend in 2015. That's why there's that blip there. The company I don't believe the company had any reason to cut its dividend in 2016, or 2015. So let's just assume that was a special dividend, a one-time thing. But again, these dividends keep going up and to the right, and they keep going up and to the right more pronounced as a result of the fact that there are less shares out there that are being paid these dividends. So again, the company's buying back stock, the company's paying great dividends, the company's using retained earnings very well. You can see where this is going. But of course, every time we talk about this, the dividends a company pays doesn't tell the whole story. There's a lot of companies that pay really excellent dividends, but they're not safe and they're not sustainable. And so when I look at dividends, I look at 4 factors, and we talk about this every week. We look at dividend in the context of yield and growth. We look at it in the context of earnings, dividend safety in the context of cash flow, and dividend safety in the context of its current debt load. So the first thing to look at is yield, right? So the yield for this company is 1.23%. To put that in perspective, the S&P average yield is 1.92%. So this company doesn't pay a great yield. If you look at this company purely if you're looking at this company purely for its ability to throw off income as a retiree, for example, this company might not make your shortlist because it's not throwing off, in terms of yield, very good numbers. But put that in perspective for a minute, because the average dividend growth for the last 5 years is 26.1%. So the dividend is small, but it's rising rapidly. Unfortunately, the company's stock is also rising rapidly, and so it's not really keeping up. But I don't really have much of a problem with this dividend yield because this company is doing so many other things right with its money. It's buying back my shares, and its retained earnings are being used intelligently, et cetera, et cetera. So I'm willing to accept the smaller yield. I sort of look at that as just a gimme because the stock is a play where the intrinsic value of this company is going to go up every year. And if that happens, I don't really care about the dividend because I'm going to have, in the long run, a company that's worth much more than it is today, and that's going to compound in a tax-free way. So dividend safety in the context of earnings, the current payout ratio is 20.1%. The average payout for the last 5 years is 25.9%. To put that in context, the average payout ratio for the S&P 500 is 40%. So one of the reasons this company pays a relatively below market yield is because they're paying out less of their profits. They're doing other things with the profits, and we've talked about that ad nauseum already in this slideshow. But certainly this is a very, very sustainable dividend because this company is paying out a significantly lower portion of its payout ratio than most companies in the S&P 500 do. So I'm told this is a harder slide for people to understand, so I'll go through it more. This is dividend safety in the context of cash flow. So cash flow is a measure of what money actually comes in and goes out. There's lots of ways that a company can generate cash. They can borrow money, they can sell companies, they can shut down operations or liquidate operations. So what we're looking at is cash flow from operations, which excludes a lot of non-operating income. So, and then we've got capital expenditures, which we assume that the company has to do to continue to stay in business. They can't shirk that responsibility. When you take cash flow from operations and you subtract out the company's legitimate capital expenditures, you have their free cash flow. That's money that the company has at their discretion to do whatever they want with. And then we want to figure out what percentage of that free cash flow is used to pay dividends. And that's the free cash flow used to pay dividends. And we like to look at that percentage and see how that compares to the S&P 500. Again, the lower the percentage that they're paying in this number, the more safe this company's dividend is, and their ability to pay this dividend through good times and bad is enhanced. So the dividend payout, free cash flow is about 25.6%. The average for the last 5 years is about 29%. The S&P 500 is in the range of 50%. So again, the company had cash flow from operations of about $14.2 billion. They spent about $4 billion in capital expenditures. That leaves free cash flow of $9.8 billion. They paid dividends of $2.5 billion. That works out to 25.6%. Hopefully that makes sense. So dividend safety in the context of its current debt load. So here what we do is we assume that the debt load will remain the same, but that interest rates will go up dramatically. And if those interest rates go up dramatically, how will that affect the company's ability to pay dividends? And what we'll find is if a company has an extremely high debt load, then at some point their interest rate increases will engulf all of their profits and not leave the company any money to pay dividends. And so we want to get a sense, how bad can interest rates get and still generate these profits? So again, you can see here that if they had to pay 20% interest, which is historically the highest we've seen in America, if they had to pay 20% interest, that would reduce their cash flow by $2.7 billion. The new interest-adjusted cash flow, which is cash flow after paying the additional interest, is $7 billion. Again, they pay dividends of $2.5 billion. So the free cash flow would still be $4.5 billion, which means they'd still only be at 35%. 35% of their free cash flow with 20% interest rates would be going to pay dividends. So the dividend is extraordinarily safe, even if interest rates go through the roof. This is basically a long way of saying that. So this company, again, this is another way of saying debt for this company really isn't a problem. Shareholders' equity, you can see that it's gone basically up and to the right. It's almost doubled since 1999. Now, it's important to remember that it's doubled despite the fact that the company has bought 30% of its shares back, which would reduce shareholders' equity, and despite the fact that it's paid all those dividends, which further would reduce shareholders' equity. So this is a fantastic slide and yet another reason to love this company. So one of the things that I really look at, I think is really important, is return on assets. A company is holding a certain amount of its shareholders' wealth, and it's saying, we need this money to operate. And the shareholders should say, great, but what are you going to generate for me as a result of keeping that? And so that's looked at as return on assets. The red line puts you in the top 10% of companies that we look at. You can see that it's been in the top 25% of companies since, let's call it 2011. And in the last couple of years, it's been flirting with getting in the top 10% where it was last year. So very, very solid company, especially in light of all the other things that's going on with the company. When a company has relatively little debt, return on equity and return on assets are going to be basically the same. The difference being that debt will dramatically reduce the equity and you get the same profits on a lower equity number. So these numbers can be goosed. But you can see that this company has very little debt, so its return on equity is in about the same range. But the good news is the company is in the top 25%, solidly in the top 25%, which when considering all factors is good enough for me. So the first question I'd like to ask about a company is, does the company have a consumer monopoly? So in this case, I think there's no doubt the company does. In fact, it has multiple consumer monopolies. And it has a very wide moat. What parent doesn't want to take their kid to Disneyland? Is there a substitute? Can you take your kid to Knott's Berry Farm or to Seven Flags instead of Disneyland? No, you might take them to those places also, but sooner or later, if you're a reasonably successful parent in terms of financial capabilities, your kids are going to Disneyland. What kid doesn't own a Buzz Lightyear and eventually Star Wars toys? Sports fans, can you imagine living in a world without ESPN and ABC is still one of the big three networks? So one of the questions that Warren likes to ask is, how much money would you have to invest to recreate this? If I gave you a checkbook with an unlimited amount of money, how much would you have to spend to not only rebuild Disneyland and Disney World and Disney Tokyo and Disney Paris and the cruise ships, and to create a movie library that includes the Mickey Mouses and Darth Vaders and everything else? How much money would you have to spend to create that? And I think the number is, it may not be possible to create. This may be just a magical thing which is in the right place at the right time. So there's no doubt in my mind this company has a consumer monopoly, and a very, very solid one, and a fantastic moat. Next question is, is the company solid financially? So the company does have more debt than I would like in absolute terms. That is $17 billion. But in the context of the size of the company and in the context of its ability to generate profits and cover its interest, and the ability and the fact that interest is such a low portion of its dividends, I just don't think debt's a real issue with this company. So I would say, yes, it's a very solid company. Does the company reward its owners? Yeah. While the dividend's below market at 1.23%, it's been growing at 26% for the last 5 years, which means if it continues, it'll double every 3 or 4 years. Since 2008, the company has repurchased 26% of its outstanding stock, and the company is using retained earnings very, very efficiently. So the company's earnings have increased generally every year since 2001, and the earnings per share have increased dramatically due to share repurchases. So the question is, would I buy this stock? Yeah, at its current price, I'd recommend this stock, but I have to caution you, this is not an underpriced stock. I don't know that I'm going to see this company go up at 15 or 20 or 25% in a 6-month period. More, it's one Charlie Munger would pick rather than a Ben Graham pick. But Ben Graham is looking for companies that are dramatically underpriced that he can buy, and then they'll go up in the relatively short term. Charlie Munger's attitude is buy great companies at a fair price, let them do what they do, and they'll make you rich in the long run. And so this is an exceptional company at a very fair price. Today it's at a very fair price, and that's good enough for me to recommend it. So in looking at our profits to date, by the way, we moved PSX. We sold our PSX stock. We bought it May 20th. We sold it on July 5th. We owned it for 46 days. During that period of time, the stock went from $84 a share to $97 a share. That's a 16.5% return on investment. So that's done great. We also own, the rest of our stocks are kind of bumping along. Some are going up. It looks like we might be selling T. Rowe Price soon. May even sell that today. And then kind of the rest of our stocks are sort of bumping along. Some are doing well, some are doing bad. But in general, I think we're doing okay. Since the period of time we've owned it, we're up about $4,800, made about $500 in dividends. We currently have about $90,000 invested. That's it for my stock pick of the week. It's Disney. Thank you very much for your time, and I appreciate any comments. I appreciate your likes. Thank you very much.